Hi, everyone. This is Jason Barrick of Wall Street from Main Street. Welcome back to another Wall Street from Main Street podcast interview. Today's special guest is a returning guest. He is Chairman and Chief Executive Officer of Adrian Asset Management. He's been managing money for decades. He's also been writing a paid newsletter with Agora Financial and elsewhere. Been reading his interviews about the gold royalty companies and gold mining companies for years. His insights are great. Adrian, thank you for joining me again.
Well, thank you very much for asking me.
So, Adrian, we're recording this interview on Friday, December 15th, 2023. Let me just get some quick stuff here about some of the pertinent market information with the dollar index. So the dollar index is down slightly to 102.59. I think a lot of people are starting to price in those potential rate cuts for the Fed. I think 3 of them in early 2024. The gold market has responded a little bit positive with a rally. But really what I wanted to ask you about is this kind of meme stock, penny stock behavior. If you look at a chart going back 3, 4, 5, 6 months of the 10-year US Treasury yield, it's a roller coaster. It's bipolar. We've gone on the 10-year US Treasury yield just in the last couple of months. October 19th, it was just under 5%. Today, when we're recording this interview, it's down there around 3.92%. Have you ever seen anything like this before?
No, not certainly not in the bond sector, that's for sure. Not in the US bonds. But you know, it's we've just got these animal spirits in the bond market as well as the stock market. People seem to think. I mean, I think there is a irrational exuberance, to quote Greenspan, irrational exuberance in expectations of rate cuts. I think for months now, the market has been first the stock market, then the gold market. The bond market held off for a while, but there's been this overly optimistic sense of when the Fed is going to start easing. I am not for a second suggesting they're not going to have to, or they won't start easing at some point. But I just think the market expectations have been a little bit overblown. And even now, I think a lot of people are acting as though the Fed's going to be cutting rates next week, and that's not going to happen. I don't think.
Yeah, I 100% agree with you. I mean, they're pricing in these rate cuts. They're looking at the dot plots. I mean, the Fed's track record of the dot plots, Adrian, you've been managing money for decades. What's the Fed's track record of the dot plots and interest rate predictions and inflation? It's not wrong, very egregiously
it's just abysmal. It's. I mean, if I and my firm had a research analyst who was presenting that stuff to me every quarter, and they were just wrong consistently, they'd be fired. They'd be out of here. And of course, it's not just the dot plots. I mean, you can go back to Bernanke, or even before that, of course. But Bernanke famously, with his calls on the housing market and recession, was just plain wrong every single time he opened his mouth. Yellen has been wrong every time she opens her mouth. I mean, to me, it's astonishing that people, I have some people who say, look, you don't understand, Adrian, the Fed chairman can't come out and say what he really thinks because it would scare people. Well, to me, that's not much of an excuse. I mean, if I don't think Ben Bernanke, for example, thought we were going to have the housing crisis that we did. I just don't think he thought that. And I tend to take people at their word unless you have a reason not to.
Yeah, I agree with exactly what you're saying. I mean, a lot of these people at the Fed, they don't do their own grocery shopping. So they believe that inflation is headed below 2% soon. Meanwhile, here in reality, the real inflation rate is not 2%. I think on the last CPI, it was claiming that healthcare costs were down 34% as some type of weird adjustment. We're just not seeing that here in reality, any of these things.
Of course not. There's not a single person on planet Earth whose healthcare costs were down 34% in the last year. I think one of the problems, though, to be serious for a second, one of the problems is that the Fed, as we know, employs, these hundreds of PhD economists, and all of these people are people who've gone from high school to university to their masters to their PhD straight into research at the Fed. They've never been in the real world, as you were just saying. They've never been in the real world. And the problem is that all of them have these very, very narrow specialties. So they're people who may know an awful lot about this particular aspect of the labor market or whatever it is. But it seems as though there's no one at the Fed, and Jay Powell was sort of the hope of some people, because he did have some experience in managing money. I'm not sure that that's the real world, but anyway, it's closer than being an academic. And so they put all this stuff into their models, but if the model itself is flawed, then putting in all these data inputs into a flawed model doesn't help get you a right answer at the other end. And of course, I think you agree. I don't want to put words in your mouth, but the whole idea that, 19 people sitting around a table in Washington, D.C. can decide what's right for the economy of 350 million people, or however many it is, that is just nonsense to begin with.
I agree. It's absurd.
Hayek explained that very well.
Faithful conceit, right, by the academic elites.
Absolutely. Absolutely.
Well, we know I've lived here in Washington, D.C. for over 20 years. I mean, you have this, even no matter how many paper degrees they have, it's still bureaucracy. So yeah, they have a lot of paper degrees, but a lot of them don't do their own grocery shopping. So they send the butler or the maid over to Whole Foods or the fancy grocery store to go get their Wagyu. They're not noticing the shrinkflation, or maybe they don't even notice what the grocery bill is. It's on auto pay.
Well, I think that's right. And I mean, I'll admit I'm a male. I live by myself, and like a lot of men, I don't know what the price of eggs. You ask me the price of eggs or milk, I have no idea what it is. I go to a grocery store, I don't buy a lot, but if I want to buy a pint of milk, I buy a pint of milk. And if it's, I don't even know what it is. If it's $1.89 instead of $1.59, I don't notice. It's only when I buy big ticket items that it really hits. But I think that the other issue with inflation is, and people have pointed this out, of course, so we may have the rate of inflation coming down, but prices have not come down. And so price increases compound on themselves. We all know that. So if we had, 5% inflation followed by 10% inflation followed by 4% inflation, you compound that, and that's 20% according to government figures, which underestimate, as you mentioned. But even if you just take those figures at face value, you're still compounding, and so we're not going backwards. And so people are, people who shop are beginning to really feel the pain.
And there's less discretionary income. I mean, we're seeing this with a lot of the data out. Inflation's, I think, going to be one of the top two voting issues in the 2024 elections. What type of lag effects, what type of damage do you think that these higher interest rates and the inflation is doing on the real economy?
Yeah, no, that's a good point, because we all know about the lag effects. Jerome Powell talks about the lag effects. But I don't think we just, I don't think we sort of really, I don't think we really focus enough on just how long these lags can be. If you look at all of the rate hiking cycles back to the 1960s, the average time frame from the beginning of a rate hikes to when we were in a recession is 22 months. So we're just about at 22 months right now. So we're right at the average, but there's good reason to think that the lag will be longer this time, and there's two reasons to think that. One is it was over a year before we went into real positive interest rates, positive real interest rates. And real interest rates are much more important than nominal rates, of course. So that's the first reason to think that it might take longer this time. In previous rate hiking cycles, it didn't take so long to get to positive real rates. The second reason, of course, to think that the lag could be longer this time is that we had over 10 years of excessively low, excessively loose interest rate and excessively loose monetary policy. And that enabled households and corporations to refinance and to term out their debt. So starting in 2022, everybody had the opportunity to refinance and get lower interest rates and to shore up balance sheets. Everyone, of course, did it except the federal government, but for some reason continued to insist on issuing 6 months, 1 year, and 3 year bills when they could have issued 30-year and even 50 and 100-year bonds. But anyway, that's a different story. So the point is that going into this rate hiking cycle, certainly the wealthier 50% of households and certainly most corporations were in a much better position, a much stronger position than they were in other rate hiking cycles. And so that's why the lag could be longer. And that brings us to the other point of why Powell's mantra, up until recently, at any rate, up until this week, of tighter for longer. I don't think he used that expression, higher for longer. I don't think he used that expression, did he, on Wednesday? Not if I remember. But his mantra that he's used for the last several months, higher for longer, that in fact is more tightening, because the longer you remain higher, the more households, the more corporations you bring in to that metric of higher interest rates. So the corporation, for example, that was able to refinance their debt, let's say 3 years ago, and issue 5-year bonds at very low interest rates, they haven't been affected by the increase in interest rates yet. I mean, other than how it affects their customer base. But come 2025, if nothing changes, they will go from a AAA corporation will go from 4 or 5% on their 5-year bonds to 8 or 10% on their 5-year bonds. That's a huge, well, that's double. And so the longer we keep rates at high, the more corporations and households start to be brought in to that higher interest rate metric.
Well, we're seeing a lot of layoffs. So we've seen a lot of layoffs from the large banks and big tech, but really the decimation, I would argue, is from the Silicon Valley unicorn companies, small businesses. Those are the ones, consumers that are not affluent, that are making, I would say, under a couple $100,000 a year. So those are the ones that have been affected the most with these Fed rate hikes, because if you were like an unprofitable Silicon Valley unicorn company that was just raising capital all the time, like WeWork or some of these other ones, and your business model was to grow revenues and then just keep like raising capital in this environment, your business model would not really a business model, but they were pitching it to investors as a business model. It just doesn't work.
No, absolutely. No, you're absolutely right. So you've got those unicorn companies. And then, as you mentioned, you've got, let's say, the lower 50% percentile of the population in terms of net worth and in terms of income. So you've got this huge discrepancy where really 50% or more of the population is feeling the slowdown, which Jenny Yellen thinks isn't happening. They're feeling the slowdown as well as the inflation very, very significantly. I think a lot of smaller businesses, to your point, a lot of smaller businesses actually were in better shape. Not all, of course, but a lot were in better shape than they were in previous cycles, I think. But we'll see just how strong a shape they're in as the US economy clearly moves into a recession. You know, Warren Buffett's great saying, Warren Buffett, I don't like his politics, but he does have a few good Midwestern, words of wisdom. When the tide goes out, we see who's been swimming naked. And, we're beginning to see that already, as you say, with some of the banks, with the Silicon Valley unicorn companies, etc.
Well, the regional banks have the most exposure to this in their loan book with high interest, discretionary income loans, high income debt loans like credit card loans, auto loan debt, small business loans, commercial real estate loans. So the regional banks look like they're going to deal with the brunt of this. And then the insurance companies that are also holding like a lot of these office buildings. Yeah,
people haven't really focused on the insurance companies. And I think that's going to be the next shoe to drop. But you're right. And of course, for the regional banks, the situation is only getting worse as more people, more savers pull their money out of the smaller banks and into the big, into the larger banks. And so it's only exacerbating the problem. But we're clearly heading into a recession. There's, in my mind, there's just no question about that. If we avoid a recession, it'll only be because the Fed monetizes the debt to such an extent that inflation moves up in a much more meaningful fashion. I think we're clearly heading into a recession.
Yeah, I agree with you. There's a lot of data that's pointing to that. And yet with a lot of the behavior for a lot of stock prices, it's been the opposite. I'm hearing on Fox Business, a lot of these generalist money managers, and all they're talking about is, I want to go risk on. I want to buy small caps. I want to buy the riskier stocks. I want to transition away from the Magnificent Seven, transition away from short-term U.S. Treasury debt, money market funds, and start putting risk capital to work. I'm hearing that a lot now.
Yeah, no, absolutely. And of course, but let's not forget two things. One is that by and large, generally speaking, if you think that the argument that there's a dichotomy in the economy between the lower 50% and the upper 50%, which is clear. But, most of the people who have money with money managers, and even to some extent with mutual funds and ETFs, they will tend to be the wealthier people. So those people have a lot of excess capital. And so if you've got excess capital, you're driving money towards riskier assets. You're telling your money manager to be a little more aggressive, and so on. You've also got the year-end phenomenon, of course, where people like to have on. If you've had a strong stock market for a year, and particularly for the last 3 months, you do not want to go into your board of directors meeting, year-end meeting, with 10 or 20% cash on your books, because they say, "What on earth are you thinking? The market's been doing so well. Why are you holding so much cash?" So there is that kind of pressure on money managers and mutual fund managers to window dress their portfolios to what has worked for the last few months.
But I think what's happening, Adrian, and you've been doing this a lot longer than I have, although I've been doing this since 2008. It just seems like the Fed has created so many distortions with what is the market's hanging on every single whim the Fed is saying now, or a change in dot plots, or a different speech from different Fed governors. The market can quickly move now from risk on to risk off. It just seems to me like this is a roller coaster. It's manic depressive, bipolar behavior. It's like a pinball game, back and forth, back and forth. And for the average person out there, it's just causing migraines.
Oh, absolutely. I mean, we see the way everybody just hangs on to Powell's speech, and you've had this for several meetings now. When the statement comes out, markets will either shoot up or shoot down. When Powell starts speaking, they'll go exactly in the opposite direction. And sometimes in the course of his hour-and-a-half press conference after the Fed meeting, the markets will have these enormous swings, 2 or 3 times in the course of his press conference. I think some of that, to be honest, is algorithms which are programmed to respond to particular words. And so if Powell uses one word, stocks shoot up, and if he uses a different word, stocks shoot down. And it's not human beings making those decisions. It's human beings who have programmed an algorithm to respond. And we're seeing a lot of that. But that's on a very short-term basis. That's an hour and a half during the press conference. But on a slightly longer-term basis, absolutely, there's no question. I mean, Powell speaks in a very dovish fashion and gold goes up. And then a few of the Fed spokesmen on Friday tried to, just draw back a little bit on the dovish impact of what Powell said. And, gold falls again. So, yeah, we're seeing, and that's human beings making those responses.
Yeah, because my interviews the last couple months, I mean, a lot of money managers I was interviewing were going risk off, and they were going to more defensive measures, to short-term U.S. Treasuries, cash, gold, regular gold, Bitcoin, things like that were more liquid. Now it seems a lot of people have switched back to risk on. But do you think that we're going to see similar things play out to how the Fed chairman, with inflation coming back in waves, and then a lot of the main consensus is just going to get screwed over here? So the people who are short covering, who are starting to get long the riskier, the risk on stuff, so the small caps, do you think they're setting up to get hit similar to what the 1970s, how inflation came back in a wave again?
Yeah, I think so. I'm not sure we're going to see inflation. Well, I don't think we're going to see inflation at the 1970 levels in the near term, but we're certainly going to see inflation levels. When we talk about inflation, you and I both know we're really not talking about inflation as it used to be known, as it used to be defined. We're talking about consumer price levels, but I certainly think we're going to see consumer price levels move up in the next few months, if only for the base effect from last year. You had lower inflation levels in lower rates of increase last year, and so even if we just stay static for the next 3 months, that base effect will mean that we'll see higher CPI readings for the next several months. Yeah, no, absolutely. And then some of these weird things like the adjustments on health insurance that we were talking about, they're going to be washed through in a few months, and so that'll start to move back up again.
So I want to transition now to the gold market. Do you think that gold prices are reflecting the inflation that we've had in the last 3 or 4 years?
No, I think the main, it's quite clear. If you look at the last 2 years, you've had gold moving up quite strongly, and everybody is sort of incredible. All the gold bugs, and I'm a gold bug, so that's not a derogatory term, but most of the gold bugs are always complaining gold isn't up more and everything else. And they forget that gold has actually done reasonably well in the last 1, 3, and 5 years. But the gold stocks haven't. And the disconnect between gold and gold stocks, in my view, comes down quite simply to who's been buying gold and why they've been buying it. So in the last 18 months, 2 years in particular, the buying of gold has been primarily central banks. As we know, there's been record buying of central banks for the last 18 months. And central banks are not buying as a speculation. They're buying as a defensive hedge, partly because of monetary instability and partly because of inflation. And those two things go along together, of course. The other buyers have been very wealthy Middle East, primarily Middle East, and secondarily Asian families and small institutions, but very wealthy. And again, those people are buying for defensive reasons, and so they are buying gold bullion. That makes sense. And if you look at gold ETFs, which would not be the very wealthy and certainly not the central banks, but that would be anyone from a retail investor to a high net worth investor who buys ETFs, they have seen outflows for the last 18 months. And consistent outflows, other than a little bit earlier in the middle of November when gold shot up, and in February, March when gold shot up. But other than that, it's been consistent outflows for pretty much 18 months. If you look at the indicator of what retail people are doing, and that is the premiums on coins, on 1 ounce coins, they have come down dramatically in the last 18 months. And all my friends in the bullion, who sell coins, tell me that demand has come down significantly. So the people who've been buying, the investors who've been buying gold, it's been central banks and very wealthy Middle East and Asian families. And that's why bullion is up, in my view, and gold stocks are down, or gold stocks are not up anywhere as much.
The demand, I would add the demand for gold too, is from non-G7 central banks. And with their trade surpluses and foreign exchange reserves, they are not net buyers of US Treasuries. So they're diversifying. For the reasons you mentioned, I would also add for diversification, they're diversifying away from dollars and treasuries that they would have had more exposure to in the past. They're not buying those treasuries that they used to. And that's why you have a funding problem in DC.
100% agree. And we could talk about that separate if you want, but to get back to the gold issue, when gold is sustainably above 2000 and closer to 2100 on a sustained basis, people are going to come back into the gold stocks. Well, retail people are going to come back into gold as an investment, as a speculation. And people are going to come back into gold stocks as well. And that's going to happen with a vengeance, because at the moment, institutions, retail investors are so dramatically underinvested in gold stocks at the moment, and in gold and in gold stocks right now. But you're going to have a very, very sharp effect, I think, on prices.
So here in the US, I mean, there's people can earn a higher interest rate on short-term US treasuries or money markets relative to gold. So there's a lot of people that are parking their short-term cash in treasuries and money markets instead of buying physical gold. But if you're in mainland China and you don't have as many investment options because of capital controls and Chinese government policies, and then from my China sources, and I know a good amount of the China hedge fund managers and China experts, I mean, they're talking the last couple of weeks about RMB devaluation. We're seeing articles that really rich Chinese people are buying like luxury apartments in Tokyo. They're buying gold bars in Hong Kong. They're not paying it for it on the mainland. They're not paying for it on the, well, actually, no, they're paying over 7% premiums, I think, in Shenzhen instead of taking the train to Hong Kong. So there's articles out about this. So I think there's in other countries, it's on a relative basis with currencies. So you're seeing the demand for gold. It's not from Americans because of the higher interest rates and the relatively strong dollar. The demand is coming from like regular people in India, China, and that's why you have gold prices in other currencies at or near all-time highs versus the dollar gold price.
No, 100%, absolutely. But I think you will, and that's absolutely true. You will start to see US people invest, because even if you can get 5% on your short-term treasuries, and I mean, we've been putting a lot of our clients' money into treasuries, something I never thought we would do. But it's a parking place. It's a parking place, because if you've got inflation, let's just take government numbers, but if you've got inflation of 4%, you're not really making any money when you're only earning 5%. And as the CPI starts to move back up again, yes, people will park money for short-term periods in treasuries, but on a longer-term basis, you realize you're losing money if inflation continues to, is stubborn and then moves back up, and people will want to protect their purchasing power, which you're not doing in treasuries.
So now I want to talk about this discrepancy between the gold price and gold stocks. So I know you do this. I also do this. I'm looking at the earnings and the cash flow projections for some of these royalty companies. So Wheaton Precious Metals, Franco-Nevada, Royal Gold. I mean, the cash flow numbers, the profit margins, they're very, very good. But the share prices, they're at 52-week lows. So if you're running some of the valuation metrics for operating cash flow multiples, profit margin, free cash flow, these businesses are making a lot of money. They're minting money. The market just doesn't seem interested in them, and the share prices are doing horribly. Do you think that that's going to change, or are these companies going to look to start to buy back shares, do mergers and acquisitions, go and buy cheap assets in the not too distant future?
Yeah, no, that's a broad question. I see a difference between the big royalty companies and the major miners. So let's just talk at the miners first, if we may. I mean, the miners, yes, their stocks are incredibly depressed. I've given some examples recently. You look at Barrick Gold, for example, which is the second largest gold mining company in the world. And Barrick, on a price to net asset value, is trading at a 40-year low. Now, that just doesn't make sense when you've got gold at 1950, 2000, when the margins, remember, everybody talks about, costs are going up. Yes, but look at the margins. And if the cash cost for Barrick is $900 an ounce and the all-in sustaining costs is 50 to 1300 and gold is approaching 2000, you've got a pretty strong operating margin. You've got a very strong operating margin indeed. You look at a company like Agnico, which is the third largest gold mining company in the world, and that is selling in the lowest 10 percentile of its price to free cash flow that it has in its entire history. Again, given where gold is and given the environment, and also, I think, given what I see as the outlook, that just doesn't make sense. These stocks are stupidly cheap, in my view, stupidly cheap. Part of a reason for that is because the broad stock market has been doing so well, but people don't see the need to rotate into gold stocks and commodity stocks generally, I should point out, because often the gold stocks will do well when the broad market isn't, and vice versa. So the major mining companies, I think, are in a pretty good state. And I'll add also that the major mining companies are in a very solid position. The major mining companies, the XAU, which is the major gold and silver companies, and it includes the royalty companies, I must admit, but they are cash positive on the balance sheet. When you think about it, you've got a capital-intensive industry that is cash positive on the balance sheet. That is astonishing. And so, yes, these companies have been increasing their dividends. The dividend yield on the XAU is now higher than on the S&P. Not that that's really saying much, not a very high hurdle to pass, but they're yielding more than the S&P. And the valuation metrics on the XAU are lower than they are on the S&P, which again is very, very unusual. If you switch over to the royalty companies, Franco is a separate case right now because they had that issue in Panama, which we can or needn't go into. But by and large, the royalty companies are not. You look at Wheaton or Royal Gold, you can say their prices are down over the last week or two, but the prices on a 6 month, 1 year basis are actually quite high. If you look at Wheaton, which is the second largest after Franco, it's selling now at $49, and back in September, back a year ago, it was trading under $30 a share. So they've been volatile, yes, no question, but they're trading closer to their high prices, not values, their prices than the mining companies are. But you're absolutely right. These companies, Wheaton, Royal, Franco, these are cash flow machines. And let's not forget, as you pointed out, is free cash flow, because the operating margin on these companies is just remarkably high. Franco 2 years ago was up as high as 90%. But even right now, let's just look, Wheaton's pre-tax margin is 63%. Franco's, I think, is about 66%. Cisco Gold Royalties is about 89%. Royal is probably, I'm guessing now, I'll look it up as we talk. Royal Gold also has a very high one. That's 45%, lower than I thought. So the operating margins on these companies, 45% still high, of course, are very high. And they're just generating free cash flow like crazy. And that leads to strong balance sheets. Franco-Nevada, which is the largest of royalty companies, that's generating over $300 million a quarter, and it's got $1.2 billion in cash with no debt. So yeah, these companies are incredibly solid. The royalty companies are not as undervalued as the mining companies, but I think they're still very, very good buys.
Well, the mid-tier royalty companies, so like you mentioned, Osisko Gold Royalty, Triple Flag, Sandstorm Gold. I mean, those ones are super cheap on cash flow metrics. They have a lot of growth already paid for, so there's good value there too. The small cap royalty ones too. I was looking at EMX, that didn't price in. They just settled one of their largest cash flow royalties, and the market didn't price that in. So I think there's good value there, but I'm just surprised that Franco-Nevada hasn't been aggressive with mergers and acquisitions because they have this narrative problem here. The market is basically valuing that deal in Panama down to zero. It took it down because the share price, what was it, $160 18 months ago? Something like that. Now it's down to around...
Yeah, well, even a month ago, they've lost 22% in the last 6 weeks since the Panama issue arose, which is almost twice the full value, as you say. The market has written that off to zero.
Well, so if I was their management, I mean, I'm looking around. We need a narrative change here. They have all this cash. They have a revolving credit facility. And they need to go out and do a deal. They need to go out and buy a cash flow asset, probably in Canada, the US, somewhere safer, and go and change the narrative immediately, saying, "Look, we're working on diversifying the company. We're going to try to get the problems or negotiate some type of settlement deal in Panama." Meanwhile, we just added smart diversified cash flow at a discount from, say, Osisko Gold Royalty, which has the Canadian Malartic royalty, which would probably be a good acquisition for them at this point.
Yeah, there's a lot of people talking about the potential of them to buy Cisco. I think there's a couple of things there. First of all, if you just look at Franco, Cobre Panama represented 16% of their NAV, and it was their highest single asset, which is high, but it's a lot less than Wheaton and Royal, and people don't really understand, focus on that. Wheaton's largest single asset, Salobo in Vale's mine in Brazil, is a little over 30% of their NAV, and Royal's largest is Mount Milligan, which is around 27-28% of NAV. So Franco was, it's ironic that they've had this issue because Franco was indeed the most well-diversified of all of the royalty companies, of the big three. I'm not talking about Osisko and the small ones now. Osisko's a midstream. So they are well-diversified. And after Cobre Panama, the next largest asset they have, Anticapaya, is 12%. And after that, they're all under 10%. They've got cash flow from over 100 different assets. So they're very well diversified. And they have a pipeline, and this is the other thing I would say, they have a pipeline of about 350 assets, of which nearly 50 are actually in development right now. So I understand what you're saying, and I understand what a lot of people in the market are saying and urging them that they should buy another company. But Franco doesn't have to do anything to increase its revenue. I mean, next year they've got 3 large streams starting over the next 12 months. So even if they do nothing, their revenues will increase over the next 18 months.
So you're saying that the risk reward here, the potential for a turnaround of the company and the share price, you're saying it would occur naturally. They don't have to go out and do a rash acquisition or something.
I think so. You mentioned that they need to change the narrative, and I think that's the big issue. Franco has positioned itself for the last several years as the largest of royalty companies, and they position themselves as being the alternative to gold bullion. You can buy us and you get the safety of gold bullion with a dividend yield. And of course, what happened in Panama has, stuck a stake right through the middle of that narrative. And I think gold investors are going to be more comfortable because they know none of us was expecting this in Panama. If you'd gone back 2 years, I don't think anyone was really expecting this to happen in Panama, but we're very used to things happening in the gold mining business.
Oh yeah, emerging markets. Yeah, always. Especially like look at copper. Look what happened when the copper price got up to $5 a pound. Chile wanted to renegotiate the royalty
Sure.
taxes on all the copper miners, and then you saw the copper production in Chile collapse. So we're used to this in
We're
emerging
used to
markets.
that. But I think the generalist investor who was sold, the generalist investor who in 2009 bought Newmont and saw the stock collapse. And then in 2011, he bought Barrick and saw the stock price collapse. And then someone says, look at our track record. Our stock price has done very, very well consistently, and it's because of our safe model. And then they get hurt again. I think the generalist investor is going to have a little bit of a time coming back, whereas the gold investor is coming back already. So I think over the next 18 months you're going to see increased revenue from apart from the gold price. You're going to see increased revenue from Franco, and given his balance sheet, which of course means that the company's not going anywhere, unlike First Quantum, who owns Cobre Panama. They have a lot of debt. So you don't have to be worried about Franco going out of business or anything. I think people will come back slowly. As to whether they should buy another company, that's an interesting thing. Franco obviously their shares trade at a good premium. But the point that Franco management has always made is that if they buy another company, they're buying a company that in and of itself, another royalty company. They're buying a royalty company that's trading at maybe 1.5 times NAV or even 2 times NAV. And if they have to buy another company, they have to put a premium onto that to get the shareholders to accept. So they'd be buying another company at maybe 1.8 times NAV or 2.2 times NAV. So they'd be buying another company at a fairly high premium to the actual value of those assets that they were buying. And in addition to that, if that weren't bad enough, in addition to that, with a diversified royalty company, they would be buying some assets that they really want, some assets that they are happy to have, but they'd also be buying a lot of assets that perhaps they don't really want, and they certainly don't want to be buying at 2 times NAV. And
Well,
that's a point that Franco's always made.
that their share price, their valuation's too high. But I mean, at some point, those older royalty assets, they're going to deplete. They have to replace it. I would argue, though, the last like 2 to 6 years, they've missed out on some of the better deals in Canada. So you've had other royalty companies that are smaller than Franco. I guess Franco's a victim of their own successes because they've gotten so big at this point and their stock price valuation was so high for so long. But they missed out on some of the better streaming and royalty deals in Canada. So they could have added a couple. Maybe they start looking at that and adding another couple deals or two in Canada if they can.
Well, yeah, I mean, I think there's two things there. One is you're absolutely right. Franco is a victim of her own success in terms of the scale and the size, where it makes sense for them to devote resources to examining royalties. And that's frankly why they did this deal with EMX, where, they can co-partner with EMX. And, we know that they're not going to, if EMX comes to them with a deal and says, hey, do you want to put $20 million into this? That they're not going to do as much due diligence as they do when they're buying something for $500 million. But they've got someone else sourcing smaller royalties for them. And that's a new deal, as you know. I think the other thing is that, I mean, for better or worse, Franco has always been more conservative in their valuations than many of the other royalty companies. So one can argue they've missed out on a lot of deals, but one could also argue that their conservatism enabled their company and stock price to hold up a lot better in the bear market we had from 2011 through to now. Which it had. It's held up a lot better. So, yeah, I understand the point, but they've always been a conservative company. They've always said we're not going to overpay. We refuse to overpay. They've been in all of these deal rooms, as you can imagine. They've made bids on virtually everything on offer. They've just always been outbid. I don't see that personally. I don't see that as a bad thing. If you look at Franco, their average duration on their assets, I think it's something like 40 years now. And that's because so many of their big assets that they bought in 2011, 12, 13, when the big multinational base metal companies were having balance sheet problems, Franco came in with $500 million deals. So did Wheaton, but Franco did more of them. Franco came in with these big $500 million and $1 billion deals where they took the gold byproduct. So they're getting gold byproduct, but on a mine that's going to last for 60 or 80 years, which is what some of these copper mines do.
Super smart, yeah.
Yeah, and so, I think that's going to pay off. If it doesn't pay off for me, it will pay off for you, and it'll certainly pay off for your children, because they're not getting any credit for that. There's no credit given if you've got in fact, it's true if you're a mining company, if you've got a 40 or 50-year mine life, you're getting paid nothing for, year 20 and year 30 and year 40.
Yeah, the investment bank analysts that cover these stocks for mining stock analysts, I mean, they're only doing discounted cash flow for maybe 9 or 10 years. So they're not even counting any of the cash flows. So the royalties could run, Franco has royalties that have run for 10, 20, 30, some even 40 years. So they're with a discounted cash flow and a discount rate. I mean, they're counting cash flows after year 10 at zero.
And we know that they're worth more than zero.
Oh, of course.
No, Franco said, now this was about 3 years ago, but they said they could stop their business, not buy another single asset, lock the door, and they could still, now this is a low hurdle as well, but they could still generate enough cash flow to pay their dividend for the next 40 years. They wouldn't have to do a thing. That's a pretty strong position to be in. So I think it's to me, it's a matter of, what are you looking for? I mean, I own, of the big three, we own all of them, but, Franco, I regard as the most conservative and the foundation. Royal Gold, for example, has been more aggressive, as you know, in the prices that they've been prepared to pay for some assets. They have paid, I can tell you, they've paid more than twice what some of, I better not say who, but some of the other large companies were willing to pay.
Well, they also bought remember the Great Bear bid like 18 months ago for the Great Bear royalty. There's not even a feasibility study on that, and they paid 150 million cash.
And what Royal Gold is saying, Bill H, I can't pronounce his second name, I'm sorry. What Royal Gold is saying is that we are placing a bet that by the time Great Bear starts producing in 5 or 8 years, the gold price will be higher, and we are paying for that. What Franco is saying is we value the royalties of our streams based on today's prices and based on today's ounces. And our upside is the higher prices that we receive and the expansion of the reserves and the resource. So it's a different way of valuing, and we own both of them. We do know that I don't think gold is going to head back, but if gold goes back to 1200, we know that Franco is going to hold up a lot better than his Royal.
Well, I don't know. There's almost no gold miners that are large or medium-sized ones other than maybe Agnico Eagle and Royal Gold that can consistently make money at even 1,300, 1,200, 1,300 an ounce. I mean, we'd have to see a lot of these costs fall long-term, and I just don't see that. I was going to ask you about...
I don't see it either, frankly, no.
Yeah, I see, unfortunately, I see input costs, whether that's labor costs in emerging markets where a lot of these mines are, cost of capital for a lot of these mines. I don't think we're going to see a lot of new gold mines being built the next 5 to 7 years. So the ones that are already funded, those costs, a lot of them are locked in. But now we're starting to see potential new projects that would start construction. They're redoing feasibility or they're being put on hold.
Yeah, yeah, and as over the last 3 years, we've had a huge blowout in capital costs, and feasibility study estimates have been exceeded not just by 10 or 20%, but Upper Cote, they were more than double. They came in more than double the feasibility estimate, which is astonishing. But I will say this about costs, it's important because, too many gold investors just look at the price of gold and they forget that the input costs go up as well. If you look back from 2005 to 2008, if you look back at those years when the price of gold more than doubled, the margins didn't actually expand at all until 2008. And that's because the price of the inputs were going up faster than the price of gold was going up. If you look at where we are now, that's not the situation at all. The largest cost inputs are in operating a mine are energy. The second largest cost input is the cost of a local currency, because that affects the cost of your labor, the cost of the cost of building a camp, the cost of all of the sort of little things that you buy on a daily basis. And that's the second largest. And if you look at where the oil price is today, look at the price of gold today compared with 2011, it's more or less the same. Look at the price of oil today compared with the price of 2011. 2011, the price of oil was $140 a barrel. It's not that, it's half that today. Look at the Australian dollar, the Canadian dollar, the South African rand, the Brazilian real. Not the Brazilian real, that's an exception, but the other three are all significantly less today than they were back in 2011. The Australian dollar at the moment is around 70 cents against the US dollar. Back in 2011, it was trading at a premium. So the costs relative to the price of gold are much less, far less today for the gold mining companies than they were last time gold was at this level.
Does that mean then that Australian, sorry to interrupt you. I want to clarify this for listeners, what you just said there in the last couple minute or so. Does that mean that the Australian gold miners then have a big advantage relative to American and Canadian gold miners then for the cost that they're selling their gold? They're selling their gold at a higher price with lower input costs and better profit margins then?
Well, I would say the advantage is for any company that has a mine in Australia, but particularly for the foreign companies that report in US dollars. So if you're Newmont and you report in US dollars and you have a mine in Australia, yes, you have tremendous margins because your costs in Australia are lower, but obviously you're selling your product on the international market. If you're an Australian dollar, you might be an Australian company, you might be reporting in Australian dollars. And so you don't quite see that benefit on your financials.
That's interesting, because isn't the Australian dollar gold price, isn't it at or near all-time highs? I mean, it was soaring for the last
years. Oh, absolutely. It is inverted. I mean, the Australian dollar, I just looked it up, is 67 cents. And as I say, back in 2011, it was at a premium. So the Australian dollar is very, very low today. Now, as the price of gold appreciates, all of what we call the commodity currencies, Australian dollar, Canadian dollar, South African rand, they're all going to appreciate to a greater or lesser extent. But at the moment, they're flat on their backs.
So you would expect then that the demand trend for gold is going to continue outside the United States with private sector demand, central bank, but there's going to be less new gold mining supply come online because some of these different factors for at least 5 to 7 years, unless...
Well, I wouldn't say 5 to 7. I think the biggest difficulty, well, there's a lot of difficulties in bringing new mines on, but one of the difficulties is the difficulty of finding large new mines. We're continuing to find smaller mines. And the thing about gold mining that makes it different from, say, copper mining or nickel mining is that you can put into production a small mine, let's say an 80,000 ounce producer that has an 8-year mine life, and make money at it. The equivalent in copper would just be laughed at. Nobody would even think about it because the capex is so much larger for the base metal mines that you have to have larger production and longer mine lives. So, but we're not seeing, if you look at the sort of, 3 million ounce and 5 million ounce, the number of new mines, new deposits being found is going down dramatically and going down consistently over the last 40 years. At the same time, the head grade of new discoveries is going down meaningfully, which means you have to have more ounces to produce the same number of, you have to have more tons of ore to produce the same ounces of gold. And so, yeah, we're just not finding the deposits. At the same time, it's getting more and more difficult, as we all know, to bring a new mine into production. The time frame from bringing a mine into production, it used to be that you could bring a small mine in Nevada into production within 3 years. You can't do that anymore. 7 to 10 years, even in a good jurisdiction, would be pretty much a minimum. It's taking longer to bring mines into production, both because of the government bureaucracy and the permitting process, and along with that, the opposition you're getting from environmentalists, and local indigenous groups and everyone else. I won't go into that whole story, but it's just taking longer for mines to come into production. And it's getting more expensive to bring them into production as well, because the cost of all the studies you have to do, the archaeological studies, the studies on insects and rare birds and everything else. So
there was a study, a large statistical study done by Canadian investment banks. Nolan Watson and Sandstorm Gold was talking about this, and they said that they went back and looked up the projected cost to build the mine on time and on budget, what it would cost. And I think over 80% of the mines that were over 100,000 ounces gold mines, over 8% of them did not come in on time and on budget. So there was a lot of additional capital costs there.
Oh, yeah. Now that the time frame of that study was how long?
I think they went back and looked up over 3 or 4 decades worth of data. It was it was mostly from Canadian Investment Bank mining analysts, and then it was sent to senior executives at gold mines and royalty companies.
Well, it's certainly got a lot worse. That situation has certainly got a lot worse in the last 4 or 5 years, no question. And the capex blowouts have been, as I say, not just 10%, but they've been 50 and 100%. So yeah, the situation there's got a lot worse. So I think we're going to see fewer large mines come on in the near future. I agree with that. And even if gold goes to 2,100 and stays there, the time that it's going to take for companies to bring new mines onto production is going to be 5 to 7 years longer than it was in the past. And, the difficulty of finding new ounces is obviously the prime driver of why there's been so much M&A recently. It's cheaper to buy your ounces than it is to find them. And of course, that might increase the gold reserves and production of a specific company, but it's not doing anything for the macro. We've got to find new ounces in order to, continue to increase production of gold.
Yeah, I think the average person doesn't understand this unless you're in the commodities business, that you have depletion, you have reserve depletion. So if Barrick and Newmont Mining and Freeport-McMoRan, which has a lot of gold byproduct, they're producing a couple of million ounces a year of gold. I mean, it's tough replacing that production when those older mines deplete.
It's very, very, very difficult. And the truth is that for the last, 10 years or more, the industry has not been replacing for the ounces that they're producing. As an industry, we are not finding the ounces to replace the ounces we're producing. Now, that on a long-term basis is obviously unsustainable, but I don't want to leave people with the wrong impression. You look at companies like Barrick and Newmont, Goldfields, they've got reserves into the decades. So we're not going to.
It's a function of price, right? So the reserves and it's a function of price, though. So I mean, if we're at a new 2,500 or 3,000 gold, I mean, there's going to be more reserves. There's going to be more potential new mines, but then the price is going to have to stay there for years longer.
Of course.
Yeah, so it can't go to 2,500 for 6 months and then crash again. There's not going to be a lot of new mine supply brought online then.
No, absolutely. But what I'm saying is that even if you look at today's price, and there's no increase in the price of gold and there's no new discoveries, a company like Barrick has 50 years worth of reserves that it can continue to produce at its current rate of production. If it brings the mines onto production, of course. But I'm saying the reserves are there. It's not like I guess what I'm trying to say is we're not going to run out of reserves in the next year or two. That's not going to happen.
Oh, yeah, I agree. But there could be more reserves. Just there could be a lot more oil. But if oil's at 150 or 200, can the consumer afford like $6 to $10 gallon gasoline and high diesel prices? So it's a function of price with these reserves. And is there actually demand for it at those prices?
Sure. So, I mean, I think the bigger issues with gold are less on the supply side, although the supply side is important, but more on the demand side.
Well, I think on the supply side, Adrian, I think we're almost out of like all the super cheap gold deposits. I mean, in terms of like way below $1,000 an ounce, I mean, there's not that many mines as potentially new mines. There's like the Greenstone mine in Canada that's almost done with construction. There's not a lot of new gold mines that are going to have costs under $1,000 an ounce. Those are just rare.
No, there's Greenstone and then the other one that just came on in the last quarter, the Séguéla mine from Fortuna in the Ivory Coast. That has cash costs of about $600 an ounce. Phenomenal mine. So I mean, but in terms of large mines, yeah, you're right. I mean, the costs are going to move up. There's no question about that. I would say. You said we've run out of cheap mines, and I would say we've run out of easy mines to find. They're becoming increasingly difficult in hostile environments, whether it's in the middle, whether it's a politically hostile environment or whether it's an environmentally hostile environment like in the Arctic Circle. We've run out of the nice, easy to big deposits that we can find in Nevada or something, and we're now moving to more hostile climates. Having said that, honestly, it's still astonishing to me to think that in a place like Nevada that has been so picked over for the last 150 years by every company out there, you can still have a major discovery such as Anglo Gold has found down at the Bullfrog district, where they're currently exploring. They plan to bring it into production, start production in 2025, with the bulk of it not till 2028 or 30. But they've got a Silicon Merlin deposit at 14 million ounces and still growing. So they're still finding big deposits, and that'll be a low-cost mine. That'll be and in Nevada. So it astonishes me that we're continuing to find these things, but most of what we're finding is in more hostile environments, deeper environments, in jungle, in the Arctic,
Yeah, I 100% agree. Or in the Yukon, Alaska, I mean, you have to build billions of dollars of infrastructure up there. There's no power lines or roads. You have to build all those things, and that adds enormous amounts of upfront capital costs.
Oh, absolutely. Sometimes you can only work for 6 months a year or less than 6 months a year. In the early days of exploration, it's all helicopter in and out. So that's very expensive. Bringing your people in and then taking them out by helicopter. A lot of these deposits they're looking at don't have nearby ports, so you'd have to build a rail line or a port. That's expensive.
So there is metal available. It's just not at sub $1,000. So we're going to be looking at higher price floors for a lot of these commodities in the future.
Yeah, I think so.
As we wrap up here, I have one more question for you then. Are there any specific, it sounds like Franco-Nevada then is a turnaround play here. I don't know if it's a couple months or 6 months, but it sounds like they're going to have more assets just on their own organically come online. Are there other industries or sectors you think that could have a bull market over the next couple of years where risk reward valuations you think are good and the sectors or industries in a bull market?
Other than gold mining, I think the copper sector is looking very strong at the moment. It was weak last year because of China's demand going down. But the story with copper, everything is a balance between supply and demand, of course, and you can't only look at one side or the other. But some stories are more demand driven, some are more supply driven. I think the copper story is very much supply driven. Even if you look at today's demand for copper and forget about electrification and electric vehicles, forget about a possible recovery in the Chinese market with stimulus and so on, forget about all of that. We simply are not going to have enough copper in 5 years' time to meet that demand, which means the price is going to go up. So I think copper is very strong. We are buying oil and gas as a longer term basis, a longer term investment. I think the supply demand is very favorable there. And of course, because of the hostility towards fossil fuels, we haven't seen the investment into looking for new oil, which means we're going to run out, and we're going to run out of the supply of oil before we run out of the demand for oil, in my view. In terms of global markets, as you know, we're a global investor, not just a resource investor. But, when you look at the risk reward, there's a lot of things I can see where I think the potential is very high, but not necessarily, but also have very high risk. So we're being extremely selective, and I can't really think of and bottoms up investor, meaning we're looking at individual companies rather than looking at a macro view either of a sector or of a country, of a market. So certainly some of the Hong Kong stocks are ridiculously cheap right now. The market is trading at maybe a 40-year low in terms of valuation. The short interest in Hong Kong is at the highest it's been in 20 years. Now, there might be good reasons for that, but the question as investors we ask is, have the prices more than discounted the risk? And I think in Hong Kong, for now, they probably have. Singapore looks very, very inexpensive to me, and Singapore is a very, very solid market, as you know. But generally speaking, we're buying, very disparate and idiosyncratic kind of situations in different markets at different times. I'm looking for situations where the stock has collapsed for a reason, but more than is justified. So, for example, British American Tobacco, the British tobacco company, believe it or not, they had a huge write-off and the stock fell very, very sharply. The symbol in the US, it trades New York, very liquid, is BTI. And they had a big write-off and fell from 32.5 down to 28.5. That's a big decline. And the write-off, in my view, was largely accounting driven. I don't think it's going to affect the dividend yield, but at today's stock price, you've got a 9.5% dividend yield, which, as I say, is fully met by earnings at the moment. And I think so I'm looking for situations like that where the market has maybe overreacted to a negative, and you can and the same would be true of Franco-Nevada, for example, where, as you said, the market has wiped out the entire value of Cobre Panama, not just 100%, but almost 200%, which is clearly an overreaction. Doesn't mean these things are going to bounce back soon, because we all know that, when stocks sell off for good reasons, they frequently go to oversold levels and stay there for a while. But, the value investor will look at those situations to try to pick things up. And that's what we're doing.
Yeah, I'm a contrarian value investor. I'm looking for undervalued growth and turnaround plays, or typically something like a Franco situation. I know Royal Gold had something similar 4 or 5 years ago. They had to restructure that Mount Milligan stream. And briefly, I think for 4 or 5 months, the shares collapsed 40, 50%. There was opportunity there.
Absolutely. No, absolutely. And, that's just what you got to look for.
Yeah, so the investors who went and bought the Mount Milligan stream, while all the negative articles were coming out about will Royal Gold fix things, they're in trouble. I mean, we're seeing similar things play out now with Franco-Nevada. And then you said that they have like additional cash flows that are organic that are coming online next year. So they do look like risk reward pretty good. Now, is this the exact bottom for Franco on the stock chart? Probably not. But over the next couple quarters, they start printing good earnings again. The market's going to start to forget that the one asset's already priced in. The bad news is priced in. That's how these markets work. If the bad news is priced in, there's opportunity there.
Yeah, absolutely. And yeah, I've never been overly worried about buying at the absolute bottom or selling at the absolute top.
Last question before I let you go. So this uranium bull market, I've been writing about it for the last couple of years. I know some people were years early on it. Do you think that this is a long-term bull market now for uranium and nuclear power?
Well, I'm the wrong person to ask. I definitely think it's a long-term bull market for nuclear power, because nuclear power, as we know, is, people don't always believe this, but it's the cleanest and the safest and the most reliable of the energy sources. And so, yeah, and I think people are beginning to turn towards that. We saw the signs at the recent COP's summit there in United Arab Emirates. More and more greenies are turning towards nuclear power, because, the more intelligent ones understand that it is a safe form of energy, and it's also reliable, which is very important when you're looking at power. To me, particularly some of the junior uranium explorers, they've moved too far too fast, in my view. So nuclear power definitely here to stay. We would be looking right now, if you're not invested, I would be looking for a pullback, and a meaningful pullback in the price of some of these companies before you buy.
Yeah, I agree. It's gotten the momentum, especially Cameco. You have these hedge funds and these generalist money managers that are piling into Cameco. I mean, I think it's around $50 a share. I haven't looked at the stock price the last couple of days, but I was writing about articles when it was $9 to $13, and then every time it rallied and had a correction or dip, people like, oh, I'm selling it. I don't believe in the uranium nuclear. So the bull market was built on skepticism and pessimism.
Absolutely, 100%. Yeah. Yeah,
but that COPS conference you mentioned there with the Davos crowd, I mean, they're talking, I think, about tripling nuclear power capacity globally over the next couple decades. I mean, if they're serious about that, they make the investments. That sounds like a long-term bull market to me.
No, absolutely. And don't misunderstand me. The price of uranium will go up. I'm just concerned about the price of some of the junior explorers who may actually never find a deposit.
Oh, yeah, I agree. Oh, the other problem is if the low-cost producers, so Cameco or Kazatomprom, they have lots of spare capacity. If they decide they want to bring back mines online, I mean, these juniors, they're not needed.
Yeah, no, absolutely. And that's what you're going to see. And we've already seen it once with Cameco bringing their, was it Cigar Lake back on? But MacArthur. But we're already seeing that as the price moves up, some of the spare capacity will come back on. And we've already had Paladin announce that, what's it called? The Heinrich deposit in Namibia, that they're going to bring that back on. That's a huge deposit. So, yeah, as the price moves up, you're going to see some of these known deposits move back up, which will see the price, fluctuate, obviously. That's what markets do, and that's not a problem. So I think the long term for nuclear power, the long term for uranium is very, very positive. I'd just be a little cautious about some of the companies that are looking for something but don't actually have it.
Yeah, I agree. The marketing materials, the Vancouver is going to be selling whatever's going up in price, the commodity price. So you're going to start to see like all these uranium juniors or companies that were gold companies, 6 months ago, gold juniors can't raise any funds there, right? So they're, we own a uranium asset. Oh, we need to change the company name. Oh, we need to
Sure.
reissue the marketing material.
Yep, like everyone's got a lithium deposit.
Unfortunately, this is how the game is played with juniors. I mean, they change the company name and then reissue the marketing materials, or it's a shell company and owns different assets, and then they raise some funds, and then when that commodity price doesn't go up anymore, they change again.
Yep.
Well, Adrian, I've kept you for over an hour. Sounds like we could talk a lot more about the mining industry and commodities. I want to thank you so much for your time tonight on Friday night. I think my listeners got a lot out of the royalty sector there. It sounds like there's good risk reward bargains there for gold mining stocks and for some of the royalty companies.
I agree. And thank you very much for having me. Thank you. I appreciate it.
And if my listeners want to check out your work, your newsletter, or your asset management, how did they do so?
Best place to go is www.adrianday.com. And then you can either go, left for the newsletter or right for money management.